Well, hello and a very warm welcome to another video all about the Forex market from Real Tail Trader. My name's Simon Gray and it is a Friday afternoon. It's around about 4:05 UK time, and just been out at a business event actually, and now back at the desk just reviewing what's happened. The beauty, I think, of trading on a 4-hour time frame is you don't have to sit in front of your screens constantly. All you need to do is do the work in the morning, which I do between 6 and 8:30 a.m, and then check the charts every 4 hours to see whether there's anything according to your rules you need to do. So being out, I protected my positions as much as possible. I've now come back and I'm going to review some of the things that have happened and some of the things that may yet happen. The other reason that, just as a matter of interest, that I like the 4-hour charts, if you're sat looking at your screens constantly all day, if you're a day trader that's looking at minute movements and you're sat in front of the screens, it's very exhausting, it's very tiring. I've tried it, doesn't work in my opinion. And of course, trading is about managing your emotions. If you're constantly looking at the screens and if you don't have a plan, it is really an emotional roller coaster and not something I would recommend. Before I get into the charts and specific setups and trades that I'm in, just the usual disclaimer, this is not an advisory service. I'm not suggesting you buy or sell or do anything that I'm doing. It really is for information purposes only. For people new to the Forex market, it's to show how a retail trader, somebody who trades from home, how I interact with the market, how I choose to do it, my personal strategy. And for those more experienced, it's maybe some insights as to how somebody else does it, maybe some inspiration or ideas for your own trading strategy. So with that said, let me review the 4 trades, now 3 trades that I'm in. And if you're following me on eToro, you can follow me there as Simon G. Forex, Simon G Forex. This was a partial trade that I had in eToro, which those of you who are following me there will have seen. So this is Swiss franc, Japanese yen. You'll see up here initial sell. This was a what I call a full house strategy. So all the moving averages that I look at were pointing south. They were giving me a clue that I should sell. I wait for a signal. This is my proprietary X signal. Sold here. I then sold again. Where are we? Sold again here. I then sold again here. So this was my sell, where are we? Yeah, 10th, so my sell yesterday. And what you can see is that from this point, when I entered this trade yesterday, prices gradually moved back. Now, this is normal activity. The market doesn't go straight down. It ebbs and flows. What I'd done is roll my stop. I'd roll my stop 20 points above this consolidation area, and we'd broken above, giving me a bit of a clue that the market may be turning against me. And as is sometimes the case, and if you've been trading for a while, you will know what this is all about. I was stopped out literally by, I think, 1 point or 1 pip. So the high of that candle, 108.538. Okay, so my stop 108.539. Of course, the spread in there, the broker took me out. So who knows what's going to happen? This may come back down and may continue in this trend. The full house is an entry star that I use for trend trading. This effectively, once I've entered, is the same rules for my trend trade strategy. I'd hold this providing price doesn't go above the 50 simple moving average. And you could argue that actually maybe the stop should have been above the 50 simple moving average, this pink line here. I roll my stops a little bit more aggressively. What I'm thinking here is that if price does reverse, which it has, and stop me out, if it comes back up here to the 50, it may give me another opportunity to get short on another full house signal. So this, when I saw this, when I was out, I saw this happen. I got an alert to let me know that I'd been stopped out. And I had 3 positions. This position clearly was a loser. I entered here and bought back my position here, but my entry here, that was break even. This entry was profitable, and ultimately this trade was profitable because what I did here at this level, this pink dashed line, is on my first position. when I'd moved equidistant between my stop and into a profitable trade, I took off half of my position. So ultimately, although this position 3 lost, this position 2 was a break even, this was profitable, because I took half the position off here, this was a profitable trade. So this goes in the win column in my spreadsheet. And one of the reasons I take 50% of my position off when I've moved equidistance between my original stop. You see the distance from this stop line here and my first entry, and entry to my first, well, the target here is the same. It gets me used to taking profits, and one of my problems in the past was not taking profits, trying to hold forever. You have to take profits to be profitable, so that's what I do now. So it gets me used to taking profits, and if the trade does ultimately go against me, which it has here, it stopped me out, well, it's still a profitable trade, it's still a winning trade, it's still added to my profit figure. For this trade is a hangover, I think, from last month to last month's stats, which I'll talk about in a moment. Just closed the book on April in terms of my stats, my performance stats, and I'll share that with you in a moment. I'll just talk about the other trades that I'm currently in. I'm currently in a Euro Swiss franc short. This trade was entered here. I've not got my indication here. Let me just have a quick check as to the entry rules on that. I think that was a trend strategy. So that was a moving average crossover effectively strategy. It's consolidated, it's gone back and forth since this entry, but you'll see predominance of candles here, YXZ, YX, YX, strong sell signals, and now we're having some push down here. What I've done is raise my targets, my initial target slightly to here. The reason being, this level was rejected before. I've moved that target. You see this level's been supported twice. I want to take off half my position, then I can roll my stop to entry, and I know I've got a profitable position. I can hold that. Hopefully, I don't really like to use that word hopefully, but we can all live in hope. Hopefully then this pushes down to the bottom of the range, and if we get a close below the 200 simple moving average on the 240 chart, my rules say that I can add to this position. So I pyramid always into my positions. Never add to losers, always add to winners. So that's starting to work now. The other trade that I have on is Aussie Yen. Okay, so this was a full house entry here. Position 1 here. Added another position here on another candle signal. We've then come back up. We've tested the 30 exponential moving average. We're now possibly pushing down, so this position is losing, this position is winning, but remember I've already taken off half my position already. So if I look at on my other screen here, if I look at my risk position, this is I will, if this trade reverses, I will lose some money on this trade, but it's going to be less than 0.5% of my capital. In fact, it's going to be about sorry, not 0.5, half of 1%, 0.05%. It's going to be less than that. So yeah, I'm trading this one in eToro. So anyone following me and copying me in eToro, patience. Hopefully we'll get down here. But again, you never know in the currency markets. Who knows? Who knows? Who knows? Who knows? My job is to follow my rules. Don't think about the money, just think about following the rules, obey the rules, and know that the rules have a probability, which I'll talk about in a moment. Okay, and the last trade that I'm in is Euro Pound. So again, this is my classic trading style that I adopt. This is a range strategy. I do 3 strategies: range, trend, and full house. Full house is really an entry signal which leads to a trend strategy. Oh, there we go. Trade Navigator's gone a bit on the blink. Usually it's pretty good, but not very good, is it? Let's hope this responds as it should respond. So let me just explain what's gone on here. Bought at the bottom of this range. I identify a range. Here we go. A range as having been tested twice on a daily chart. I use the daily chart to determine whether we're in a range or a trending market. So test here, test here, test here. That was the one I bought on. Test here, test here. That to me is a range as I define it per my rules. So bought here, position 1, We then got we then closed above the simple moving average, the 200 simple moving average. I bought again, so both of these positions are now in profit. What I've done is set my target, my limit order in eToro. That's what ET means, and on my private broker here, set my target here to take that position off. So that will be a very profitable trade if we get there. If we don't get there for whatever reason, you know, this is a risk-free trade now, because the win I've had already and the profit I'll have on my open positions if we come and hit this stop. You'll see the stop is below the 50 simple moving average and the 200 simple moving average. If we get below that, you know, the market's telling me it's not playing ball with my approach at this time. So I think there's a really high probability we'll get up into this top, where I'll sell, make a profit on the position, and then I'll consider selling and moving back down the range, unless of course we break above here and we move off, in which case if we break and close above the edge of the range, we're then into a different type of market. Now on this trade, I just want to talk about one thing in particular that does crop up time and time again. I'm just going to blow up the chart so you can see. I want to talk about this candle here, this Z candle. Okay, now this candle occurred yesterday at 6 o'clock. These are 4-hour candles, and the market had moved up. Okay, now we got to this point here. Now if I do what many traders do in the market, if I take a Fibonacci retracement, and I used to use these, I don't really use many signals, as you'll see. If I take a Fibonacci retracement from the high here, the low here, let's just have a look. I've not done this, so I'm going to see where we end up. So a little bit hard to see. Let me just edit that, and let's put 618 and let's put 786. Okay, there we go, as I suspected. Now Fibonacci retracement, for those of you that are not familiar with this term, it's a tool in trading that sometimes people use. They trace the high to the low and look at the retracement back. There's a 50% retracement on here, 61.8 retracement, which many believe that's when a market will reverse if we're in a trending market, and 786, 0.786. Now if I was looking at this market as a trending market, I could have been very, very tempted, depending on my rules, to sell on this candle. It's hit the 786. Okay, great, we're coming back down to make a new low here. Now that's if I believe this market was a trending market. Now because I've, according to my rules, classified this as a ranging market, then I know that actually, as I define the market, we're not in a trend. So I knew to ignore that signal. You know, it's not part of my rules anyway, but you know, thinking about other people in the market, they may have reacted to that. So it's very important, what I'm trying to say is it's very important to know which type of market you're in. Are you in a trending market, lower highs, lower lows, or higher highs, higher lows, or are you in a ranging market? Because the strategy that you play and the rules that you will have need to be completely different. Because one of the mistakes that I have made in the past, I've been trading for quite a long time now, is that I would play a range strategy in a trending market, or I wouldn't distinguish. In fact, a better way to describe it, I wouldn't distinguish between the two types of market. So classic thing I've done in the past, I wouldn't have identified this as a ranging market. What I would have done is seen this come down, it started to retrace, I'd have sold on the 50, got stopped out, sold on the 61.8, got stopped out, probably sold on that candle, got stopped out, and pretty quickly start to eat into my capital, simply because I'd not identified the correct type of market. So just wanted to give you a heads up on that. One of the major changes I made in my trading strategy, very, very simple. I spend time, energy and effort discerning, according to my parameters, whether we're in a ranging or a trending market. And that's why I have a strategy for a range and I have two strategies for a trending market, and that's it. So just wanted to talk to you about that. Okay, so numbers are in for the last month, for April. So I traded my 3 strategies in April. You won't see this in eToro because I've only just started on eToro, but basically my results for April were I traded 29 times, so I entered 29 trades. Of those 29 trades, I had a 55.17% win ratio. So over 50%, that's okay. I'm going to try and move that higher. My prior month in March was 58.33, so a slight drop on that. Because I traded more, 29 trades, I made a very decent profit. And if I'll give that in percentage terms on my capital. So let me just work that out. I'll tell you now. So that's an 11.68% return on my capital. Now, 11.68% return. If you think about that compounded, if I was able to do that every month, it's not easy, but it is possible. Then you're looking at 140% return on capital at the start of the year. So, when people say to me that currency trading is risky, yes, it is. But like anything in life, it's risky if you don't know what you're doing. And, if I was to go ice skating, I can't ice skate, that's risky. But somebody who knows how to ice skate, well, ice skating is not risky, or pick any sport that you wish. So for me personally, there is an option to trade my own capital and be in charge of my own success or failure, success hopefully, or is to give that responsibility to somebody else. And I think the right balance in life is you do a bit of both. But, I have a portfolio that I trade. I have some money that I trade. If I put that in the bank, what am I going to get in the UK? Well, less than 1%. I've just done a 11 point, whatever it was, percent return, 11.68% return in 1 month. So that to me is one of the appeals of trading. The other appeal of trading is the fact that it's something that works very flexibly with your life. You don't have to be sat at your screen all the time. You can do it anywhere in the world. And the other thing is it's fascinating, because what trading is all about, it's not about chart patterns really. It's not about pretty pictures and it's not about special indicators. What it is about is human psychology. It's about trying to get under the skin of human psychology. And as I am a human being, I have just as chance as everybody else to get under the skin of that. So what human psychology happens here? Let me explain. So, didn't trade any of this. This was setting up my interpretation of the market. But look, when people bought down here, they bought. They got to the top here and they're thinking, oh crikey, this is where maybe I should take some profits now. I'm getting slightly nervous. Will the market go any higher? Well, it didn't before. So people start to sell, and as people start to sell, those buyers start to exit the market, and there's a change. More sellers come in, and we come back down here. We get down here. Is it going to go down any further? Well, it didn't before. So the sellers exit with a profit, and new buyers come in, and this is what happens time and time and time again. And I've just reminded myself, talking too much, I was going to talk to you about this candle. So one of the reasons that I ignored this candle is because, let me just take that off, is because I read this candle differently to somebody who was viewing this as a trending market. Now, if you look at this level here, or thereabouts, okay, this was kind of the consolidation level. That was the 2 o'clock candle, that was the 6 o'clock. So this is the overnight consolidation. Okay, I like to look at the overnight consolidation because usually you'll get some kind of break above or below. In fact, let me duplicate that. So this is the overnight consolidation. In fact, let me draw that in a different color so you can see that. Let's put it in, I don't know, let's put it in grey. There we go. That's kind of the overnight consolidation. And what happened here is price broke above this overnight consolidation. Could have been on a piece of news, happened quite late on in the day, and buyers, well, it wasn't actually buyers, or not the buyers you think it was, I don't think. So what happened here is that anybody here that was short the market, anyone here who'd said, okay, I'm going to sell here and put my stop loss up here, this was people getting out. They realized they're on the wrong side of the trade and their stops are here. Their stops get hit, so they're buying back their short position. This is what pushed this candle up so high and why it fell away. And the reason for that is it's what's called a I call it a stop run. Doesn't really matter what it's called. It's when people are forced, because the market's going against them, their stops are triggered, stop, so they're buying back their positions up here. As soon as that stop run has gone, market often falls back down to where it started. And then we wait for new buyers to come in, which is what's happened here, here to a certain extent, here and here. A little bit of pressure now down there. So I look for this kind of thing, and it doesn't worry me too much because I understand the psychology behind the market. Anyone who sold here, and realized the market reversed, it's hit their stops, which are here or here, probably 10 points above that level, and they're having to get out. Bang. As soon as the stops are cleared, the market falls, and then we wait to see if new buyers come in, which they did. So this would have been a great candle here to add to the position. I was already in a position here, but this would have been a great candle because it's showing that buyers are coming back in once that stop run has been hit. So anyway, talk far too much. Those are the trades that I'm in. The two messages of today on this video is, even when it looks like you may have had a losing trade, if you're taking profits as you go with your initial target and you're rolling your trailing stop, then what may on first glance appear like a losing trade is actually a winning trade. That was my Swiss franc Japanese yen trade. And here the message of this was two things really. Know which market you're in. Are you in a trending market or a ranging market? Otherwise you may take the wrong signals and play the wrong strategy. And when you see this kind of stop run activity, it can be a really big clue. Instead of to sell, it could be a really good clue to buy, depending whether the psychology behind that is as I've described. So I hope you found that useful. Have a great weekend. There'll be no videos for the next couple of days. I'm going to roll my starts, protect my starts ahead of the weekend, hold the positions over the weekend, and see where we get to next week. Looking forward to next week. It's a full week here in the UK. We had a bank holiday this week. I always find that's a frustrating week for trading. But anyway, until next time, trade safe, and I'll talk to you soon.